Today, after Red September, inflation. Market update for the 2nd of October 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's show, we look at the latest from the markets as inflation appears to be becoming more entrenched and stagflation could well be on the cards. Economic indicators in the US, China and elsewhere are at best mixed and at worst signalling higher risks ahead, and markets remain volatile. Will we see a red October too? You could say the hunt is on. Despite Friday's rally in stocks, the S&P 500 still suffered its biggest weekly slide since February. And former US Treasury Secretary Lawrence Summers said investors may be tuning in to the risks of an overheating US economy and the chance that pushes the central bank into a faster withdrawal of monetary policy stimulus. The reopening of the global economy will likely lead to high inflation for the next 12 to 18 months, said BlackRock Vice Chairman Philip Hildebrand. There's a lot to sift through for investors, and I think that's what you're going to see with the increase in volatility, said Ryan Newman, market strategist at Zephyr. Investors are waiting for more of a correction. Even though markets have come down in September, valuations remain elevated, and you have some parts of the economy that are slowing, and that's all starting to play a role in investor sentiment. Earlier in the week, Fed Chair Jerome Powell told the ECB that transient inflation will go on for longer than expected, and now the latest edition of the closely watched measure of US inflation revealed the largest increase on an annual basis since 1991. The Personal Consumption Expenditures Price Gauge, which the Federal Reserve uses for its inflation target, rose 0.4% from a month earlier and 4.3% from a year earlier. So this begs the question, will rising inflation eventually hit consumer spending? Well, the latest data on US personal spending revealed an increase of 0.8% from a month earlier, following a downward revised 0.1% decline in July, according to data from the US Commerce Department. Spending in July was previously reported at 0.3% gain. The spending increase was driven by a jump in goods outlays, specifically food and household supplies, likely reflecting a shift away from activities like dining out and travel due to heightened health concerns. Even though spending, which accounts for about 2/3 of gross domestic product in the US, rose in August, the downward revision to the prior month points to only a scant gain in third quarter outlays, according to Wells Fargo. The core PCE, which excludes food and energy, rose 0.3% for a second month, and that measure was up 3.6% from a year earlier, matching the highest since 1991. Supply has struggled to keep up with rapidly recovering demand since the start of the year, with companies looking to fill a record number of open positions and acquire the materials needed for production. Those constraints have pushed prices higher and eroded America's buying power. That said, a measure of manufacturing expanded in September at the fastest pace in 4 months, bolstered by robust demand for factory goods and more inventory. The data suggests manufacturers are making some headway, working through still elevated order backlogs, but persistent shipping challenges continue to elongate delivery times. Fed Chair Jerome Powell said this week that the supply chain disruptions which have been lifting inflation rates around the world will ultimately prove temporary. It's very difficult to say how big the effects will be in the meantime or how long they will last, but we do expect that we'll get through that, Powell said on Wednesday. And the economic indicators remain mixed in the US, with personal incomes up 0.2%, after increasing 1.1% in the prior month due to a boost from an advanced disbursement of the tax child credit. Wages and salaries climbed 0.5%, but disposable personal income, or after-tax income adjusted for inflation, decreased 0.3% in August, and the US savings rate, which has been elevated for months as a result of stimulus checks and enhanced unemployment benefits, dropped to 9.4%, from 10.1%. We remain constructive on consumer spending in the coming quarters, even as the impulse from fiscal stimulus targeted at households fades. Labour market income and a savings cushion should support continued spending, Morgan Stanley said. In Washington, meanwhile, House Speaker Nancy Pelosi was forced to delay a planned vote on the $1 trillion bipartisan infrastructure package amid ongoing wrangling within the Democratic caucus. The House was hoping to pass the bipartisan infrastructure package and the $3.5 trillion reconciliation bill simultaneously as part of a two-track strategy, but Senator Joe Manchin said he would support a reconciliation package worth only $1.5 trillion, well short of that proposed $3.5 trillion. House Democrats are trying to break a stalemate that's holding up a vote on legislation for the $550 billion in new spending on infrastructure that is supposed to be the first component of President Joe Biden's economic agenda. Meantime, Fitch Ratings said the US AAA sovereign rating could be at risk if Congress fails to raise the debt limit. And elsewhere, record price gains and fevered competition are crushing prospects for US home ownership, a key driver of middle-class wealth. First-time buyers accounted for just 29% of existing home sales in August. That's the lowest share since January 2019 and below the 5-year average of 32%, according to the National Association of Realtors. The share of government-backed mortgages often used for purchases by young people has also plunged since the start of the pandemic. It's a stark example of America's uneven economic recovery. Soaring real estate values have gifted homeowners with record equity, with an average increase of more than $50,000. But record low borrowing costs, which should have made housing more affordable for young renters and minority groups historically of ownership, instead drove prices higher and pushed them even further behind. It's extraordinarily hard to become a homeowner for a range of reasons, most significantly that prices have gone skyward, said Mark Zandi, chief economist at Moody's Analytics. The next shoe to fall is higher mortgage rates. As soon as that happens, and it will, homes are going to be completely out of financial reach. Meantime, the S&P 500 rose sharply on Friday as positive result from Merck's COVID-19 pill stoked investor optimism and triggered a sea of green on Wall Street following a shaky September. The S&P 500 rose 1.1%, the Dow Jones Industrial Average gained 1.4%, and the Nasdaq was up 0.8%. Merck & Co. reported that its experimental COVID-19 pills cut the risk of death and hospitalization by 50% in the study, sending its share price more than 8% higher to close at $81.40. The positive COVID-19 treatment news stoked investor optimism about the recovery amid an ongoing drag from the impact of the Delta variant. Cyclical stocks, including materials and energy, took the lead, with the latter helped by expectations that energy prices will continue to climb to as high as $100 a barrel. If all these factors come together, oil prices could spike and lead to a second round of inflationary pressures around the world, Bank of America said. Bets on reopening stocks, those that benefit from easing pandemic restrictions, are renewed, with cruise and airline companies leading the way. And some banks, though, took a hit, with the financials index down 1.62% to 624, while others ended in the green. Wells Fargo was up 1.31% to 4702, despite a federal judge on Thursday rejecting Wells Fargo's bid to dismiss a lawsuit claiming it defrauded shareholders about its ability to rebound from 5 years of scandals over its treatment of customers. The fourth largest US bank has operated since 2018 under consent orders from the Federal Reserve and two other US financial regulators to improve governance and oversight, with the Fed also capping Wells Fargo's assets. Shareholders said bank officials falsely claimed in television interviews, analyst calls and congressional testimony that the bank was mending its ways when regulators actually viewed its progress as deficient and unacceptable. The volatility index was down 8.6% to 2115. Gold futures for December delivery was up 0.17% to 1,759. Crude oil for delivery in November rose 0.92% to 75.72, while the euro-US dollar was up 0.13% to 1.1596, and the US dollar's futures index was down 0.19% to 94.05. The Organization of the Petroleum Exporting Countries and Allies, led by Russia, a group known as OPEC Plus, are scheduled to meet on Monday and could boost production beyond the 400,000 barrels per day already agreed to for November and December, given the backdrop of oil hovering near 3-year highs. And looking ahead, investors anticipate another wild week amid several events that could dominate direction in the broader market, including the Federal Reserve's September meeting minutes, the OPEC meeting, and the monthly jobs report to round out the week. Fed Chair Jerome Powell, European Central Bank President Lagarde, and the Bank of England Governor Andrew Bailey shared that inflation remains and could remain elevated for longer than they estimated. However, they maintained the view that the surge in prices could still prove to be transitory. Of course, the question there is how long is transitory? Their comments added to speculation for earlier than previously expected tightening by the Fed and the Bank of England. The ECB not so much, though, because this bank made it clear that it can tolerate overshooting inflation and refused to discuss tapering. While the ECB slowed its Pandemic Emergency Purchase Programme, the PEPP, purchases at its latest gathering, it hinted that it could compensate through other schemes when the programme ends. So the ECB, I think, would prefer to move later rather than earlier. Inflation in the euro area accelerated more than expected, though, to the highest level in 13 years, adding fuel to the debate about how long the post-crisis spike will last. The core measure, which strips out volatile components, such as food and energy, climbed to 1.9%, a rate not seen since 2008. But European manufacturers are increasingly strained by global supply chain problems that are pushing up prices and may last well into next year. A gauge by IHS Markit measuring business activity at factories fell the most since April 2020, and growth in new orders, output, unemployment slowed considerably. So European stock markets were down on Friday, starting the fourth quarter on a weak note on concerns of rising inflation, and that may prompt central banks to withdraw stimulus just as growth is slowing. The DAX ended down 0.68% to 15,156, while the UK's FTSE dropped 0.84% to close at 7,027. Those losses followed on from weaker news in Asia earlier on Friday, with the Nikkei index in Japan dropping 2.31% to 28,771, while markets in Hong Kong and mainland China were closed. The disappointing news continued on Friday as German retail sales rose 1.1% on the month in August, a rebound from the revised 4.5% drop the previous month, but below the 1.5% increase that was expected. And in corporate news, Daimler stocks fell 2.6% as shareholders voted on potentially spinning off its truck-making division from its Mercedes-Benz luxury car operations. A similar move by Volkswagen, down 2.2% 2 years ago, has done very little to unlock additional value in its truck business. UK retail stocks suffered more than most as investors priced in the likely hit to consumer spending from a tightening of fiscal policy as the government withdraws many of its pandemic-era supports. And global markets have been unnerved by persistently high inflation while growth appears to slow and central banks look to withdraw their accommodative monetary policies. Activity in China's vast factory sector contracted in September for the first time since the pandemic began, and that's the latest sign of deceleration in the world's second largest economy. Global food costs are at risk of soaring again as China faces a challenging harvest season due to a severe energy crisis. Over the past year, China had to import a record amount of agricultural products due to a domestic shortage, driving prices and global food costs to multi-year highs. But then what of Evergrande? Well, Bloomberg succinctly put it, the Evergrande fear has receded too easily for comfort. As John Authers wrote Monday last week, when difficulties of the stricken property developer China Evergrande Group first prompted a wave of fear in US markets. As the intervening days have brought ample fresh excuses to sell, for those who wanted to sell, that implies that people are far more confident about the Evergrande situation now. But it's hard to see why, he says. Some of this can be down to the psychological concept of anchoring. 2 weeks ago, the question was whether Evergrande would turn into a Chinese Lehman crisis. The odds look good that it won't, he says. Once this had been duly internalised, it became much easier to ignore disquieting evidence that Evergrande will do significant damage to a Chinese economy that already appears to be slowing. In terms of new news, we now know that Evergrande is starting to pay money it owes to people who hold its debt through wealth management plans, or WMPs, which are China's most popular retail investment vehicles. However, it has still only paid the first 10% of what was due last month. In itself, this implies a 90% haircut is still possible, which could be a horrific outcome. We also now know that the government has been prepared to buy a stake in Shengjing Bank, a regional lender from Evergrande. This was a classic move to limit the risk of financial contagion at the Lehman, and helps to confirm that China isn't going to let Evergrande turn into a generational crisis if it can help it. As Beijing does have the tools to stop that happening, that's good news for the rest of the world. But the priorities that the Chinese government is showing should alarm more or less everyone. WMP holders need to be paid something because there are a lot of them, and an Evergrande default would hurt them grievously. There have already been angry demonstrations over the issue, so domestic political stability and the survival of the communist leadership remains paramount, as they have been for decades. Meanwhile, buying the Shengjing stake not only helped Evergrande and all its creditors, also helped out a long list of ultra-wealthy stakeholders in Shengjing, many of them politically connected and good friends with Hu Kaiyang, Evergrande's billionaire founder. It looks like crony capitalism. And finally, there is the issue of foreign creditors. At the time of writing, there has still been no payment to holders of a dollar-denominated bond who were due to be paid on Wednesday. At this point, it looks like the priorities are simply these. First, avoid a systemic Lehman-style crisis. Second, avert popular unrest over WMPs. Third, make sure all the well-connected cronies are okay. And fourth, maintain good relations with overseas investors and creditors. But he says number 4 at this point seems to come a long, long way behind the other 3. This may well be a defensible set of priorities for the officials trying to manage the crisis in China, but it's not great news for international investors. It would imply a much slower flow of investment money into China in future, and likely would portend more damage for dollar-denominated Chinese assets. Evergrande was down 3.91% on Friday to $2.95. The iron ore price edged lower on Friday, with China fines 62% down 1.87% to 115.47. And China, of course, is now also facing power problems. China's power crisis looks set to spur it to import more coal from a wider range of producers, putting it into competition with European and Indian buyers that are also snapping up more of the dirtiest fossil fuel. More than 2/3 of China's electricity comes from coal-fired plants. And while more than 90% of the fuel it uses is mined locally, it's difficult to raise local output at short notice. Looking offshore is the easy option, but that's been complicated somewhat by Beijing's decision to ban imports from Australia, the world's second biggest exporter, late last year. It isn't easy to ramp up local coal supply, given the low investment in new mines in recent years, so China is likely to try and increase purchases from traditional sources. Jilin province will seek more coal from Indonesia, Russia and Mongolia to ensure power supply and heating, Governor Han Jun said in a statement. Coal futures continue to break fresh records to $218 per metric tonne after gaining 27% in September and adding 171% so far this year. Several factors have been pushing those coal prices up, including tight supply in China, as the country vows to achieve emission standards and to reach carbon neutrality by 2060, plus a lack of mine investment reflecting pressure from socially conscious investors, and imports constrained due to coronavirus restrictions and a surge in natural gas prices amid prospects of a shortage in inventories, especially in Europe. And meanwhile, the Chinese National Development and Reform Commission formally urged local economic planners, energy administrations and railway companies to increase coal transportation to meet citizens' heating demand during the winter season. Fuel oil stockpiles in Asia's storage hub of Singapore dipped to its lowest since September 2019 as more demand emerged from the power sector amid a pre-winter surge in gas prices. And Drewry's Composite World Container Index inched down by 0.2% to $10,360 per 40-foot container this week. That composite index is still 291.8% higher than a year ago. Inflation, anyone? And so to Australia, where Australian shares fell this week as markets grappled with the prospect of central banks tapering and the risks posed by lingering inflation and rising bond yields. The ASX 200 dropped 2.1% this week after plunging 2% or 146 points to 7,185 on Friday. Shares put on 1.9% on Thursday, the final session of the September quarter and the best this year. The risk of a more severe correction remains high, particularly with seasonal weaknesses for share markets running into mid-October in the US and into November in Australia, said AMP Capital's chief economist Shane Oliver. Heavy falls posted by the major banks on Friday dragged on the market. CBA tumbled 4.1% to $100.08. National Australia Bank dropped 2% to 27.27. ANZ fell 2.5% to 27.44. And Westpac declined 2.3% to 25.41. Macquarie Group dropped 2.9% to 176.70. A 4.5% rise in the iron ore price wasn't enough to protect the major producers. Rio Tinto dropped 2.9% to 97.28. Fortescue dropped 2.6% to 14.57. BHP dropped 2% to 36.85. And Mineral Resources closed 6.9% lower at 41.74. Other miners caught up in the sell-off included Pilbara Minerals, down 5.4% to 194, and Chalice Mining, down 5% to 607. UK lender Virgin Money was the biggest laggard after announcing an expensive acceleration of its digital strategy on Thursday afternoon. The stock dived 7.4% to 374. But travel stocks proved a glimmer of light as Prime Minister Scott Morrison confirmed that international borders will open in November. Flight Centre firmed 1.8% to 21.85. Webjet advanced 2.1% to 6.47. Qantas climbed 0.7% to 5.71, and Hello World Travel closed 5.5% higher at $2.70. And finally, in crypto, prices bounced higher on Friday, with Bitcoin up 9.8% to 48,157 and Ethereum up 10.25% to 3,310 at the time of writing. This week was pretty busy, with Monday starting with notorious Bitcoin critic and JP Morgan CEO Jamie Dimon saying that Bitcoin could go up 10 times, but he doesn't care. At the same time, their competitor Morgan Stanley revealed that they had more than doubled their investment in the Grayscale Bitcoin Trust to 58,000 shares during the last quarter. As Bitcoin tipping on Twitter started taking off, Strike CEO Jack Mallers said that he would donate all the tips he received on the platform to the Human Rights Foundation. And later on Monday, Miami Mayor Francis Suarez started advocating for Bitcoin miners to switch to nuclear power, a clean and efficient alternative for fossil fuels. He said that Miami could become a clean Bitcoin mining hub. Ending Monday off on a high note, El Salvador revealed that over 2.25 million citizens are now using the Chivo Bitcoin wallet. No small feat, considering it was only launched 3 weeks ago. Coinbase revealed a new feature that would allow users to automatically convert their paychecks to Bitcoin on the platform. And finally, US Senate candidate Blake Masters said the US government should buy a strategic reserve of Bitcoin. On Tuesday, the world's largest provider of Bitcoin payments, BitPay, announced a partnership with Verifone to allow their merchants to accept Bitcoin payments. And ATM maker Athena also announced that Salvadorians will be able to receive their salaries through the company's ATMs. El Salvador's president also shared a video teaser of the country's plans for mining Bitcoin using geothermal energy generated by country's volcanoes. Rich Dad, Poor Dad author Robert Kiyosaki warned that people should buy Bitcoin before the biggest market crash in history, referring to an expected stock market crash. On Wednesday, in an interview Elon Musk discussed crypto regulations and suggested the US government do nothing regarding regulating Bitcoin and the overall crypto market. And Cathie Wood's ARK Invest also revealed that they had purchased $42 million in Coinbase shares on Tuesday. Also on Wednesday, Umbrel unveiled their first plug-and-play Bitcoin node, a big step in bringing users sovereignty. Despite China's moves against Bitcoin, it was revealed on Wednesday that there was still more than 145 Bitcoin nodes active in China. Closing out news for Wednesday, Cool Valley, Missouri Mayor Jason Stewart revealed plans to give each household in the city $1,000 in Bitcoin. On Thursday, as September drew to a close, El Salvador's president announced that the country would give anyone using the Chivo Bitcoin wallet a 20-cent per gallon discount on fuel, pushing for further adoption in the Central American nation. Also on Thursday, US Federal Reserve Chair Jerome Powell officially stated that the US government would not ban Bitcoin nor any other cryptocurrencies in the country, in contrast to China's most recent ban. That's an important signal for people in the US and throughout the world who are still wary of investing in Bitcoin. And then on Friday, the Salvadorian government started mining its first Bitcoin powered by geothermal energy, becoming the first country to mine Bitcoin, starting a green energy Bitcoin mining revolution. And funnily enough, it also came just 2 days after the CEO of the Tehran Stock Exchange resigned after Bitcoin miners were found in the exchange's basement. So standing back, you can see that there is a lot going on, a lot of volatility ahead, and a lot of uncertainty. Sufficient evidence, I think, to suggest that October will likely be a red month too. But hey, what do I know? I just watch for the signs and try and make sense of what's going on as the information comes in, and I'll continue to do that over the next few days. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.